Good evening and welcome to the big story on NDTV Profit. I'm your host Nupur Talwar Suri. Well, it is a big gift from the Reserve Bank to the government. Over 2 lakh crore rupees of the surplus funds will now be transferred to the government. Now, this is the highest ever surplus fund transferred by the RBI, and this has a number of implications. The amount, of course, will help manage the country's fiscal deficit. And remember that the Prime Minister had spoken exclusively to NDTV Profit and outlined his 100-day plan. Now, this surplus, of course, could give the much-needed boost for that. That plan, of course, will be initiated once the new government comes in. Now, joining me on the broadcast to discuss all this further are my colleagues Vishwanath Nair. Pallavi Nahata is, of course, with me in the studio, and we'll also have Janani Janarthan joining in from Delhi. We also have Mr. R. Gandhi, the former Deputy Governor of the RBI, joining us. Good evening, all of you. Thank you very much for joining us. First, let's, get the basics right, and let's go to Pallavi first. Pallavi, to begin with, explain to us how this RBI fund transfer actually works. What happens?
Right. Nupur, like you've mentioned, the RBI is set to pay 2.1 lakh crore rupees to the central government. That's the highest ever surplus. And it's also almost 2 times what was budgeted by the government and what was in line with economist expectations. Now, the higher surplus could be summing from higher interest income on foreign securities, from lower provisioning to market losses on foreign securities. Higher than expected income and gains from FX sales. We'll of course have to wait for the RBI's annual report for greater clarity on what exactly are the sources behind the RBI being able to make this higher transfer. But what's also important is, what are the implications of this figure? First and foremost, of course, fiscal deficit. Now, the government had budgeted 5.1% of the GDP for FY24. There is a chance that this number could now be a lot lower. That's, of course, assuming that expenditure remains constant. So some economists we in fact spoke to said that the fiscal deficit could now be lower by almost maybe about 30 basis points. The second implication is, of course, the figure means that there is greater room for the government to maneuver around maybe how it plans its expenditure for the ongoing financial year. Basically, what we're going to be watching out for is, of course, the next budget and how the government factors in today's figures and how it balances its expenditure accordingly, and, of course, the fiscal deficit target.
All right. Vishwanath, if I could come to you now. Vishwanath, the question that's going to be on everybody's mind today is, where is this huge number coming from? Now, it's the highest payout in recent years. What, according to you, is the story behind it?
Well, it's pretty clear during the year that has gone by. There was a lot of foreign exchange sales, primarily as part of the RBI's foreign exchange management process. They do sell the parts of the reserves to stabilize the rupee against any undue volatility. Now, we know that the foreign currency, especially dollar, did strengthen quite a bit during FY24. So some of that could be coming from there. You could also have higher interest income on foreign securities that the RBI holds, primarily because there's been a significant jump in the yields on a global basis. Of course, all of this is at this point in time just conjecture because, as Pallavi did mention, the annual report will come out in some time, and then that will give us a better clarity as to where RBI's income boost is coming from during the current year. One important point to remember here is the contingency risk buffer that the RBI is maintaining at 6.5% in FY24. This was 6% last year and 5.5% before that. So consistently, along with these large transfers and the strong growth that the RBI is seeing on its balance sheet, it is setting aside more money for any undue risk that might come in later, so that the RBI's balance sheet is protected at all points in time against any such volatility. So that prudence part of it remains pretty strong. 6.5% is the higher end of the CRB, or the contingency risk buffer, that was recommended by a committee headed by Vimal Jalan back in 2019. So the RBI has come to the higher end of that spectrum from 5.5% to the lower end of that spectrum. So that's obviously something that needs to be watched out for, and something that we need to definitely see. Definitely note as part of the RBI's surplus transfer processes.
Right. We were talking about this earlier. Now, in 2019, of course, the risk buffer had actually decreased. And I'm going to come back to you on that one, Vishwanath, in a bit. But just to introduce Madhavi Arora, lead economist of Emkay Global, also joining us. Good evening, Madhavi. Thank you for joining us. First, going on to Janani now. Janani, what are your thoughts on this huge bonanza for the next government? Obviously, this is perhaps going to impact the fiscal deficit for FY25. What is it that comes to your mind when you think of it, top of your head?
That's right, Nova. Thank you. Two things on the top of my mind. One, either way we slice it, this is much higher than what the government has anticipated. If we go back to what the government receipts were expected in its interim budget, it had only pegged about 1.02 lakh crore coming in from RBI and other bank dividends. Even if we include what they expected from PSUs, that's about only 1.5 lakh crore. So essentially, the figure where it stands now at 2.1 lakh crore is much higher. Two things that I see pivoting from this, of course, is it could, of course, oil that fiscal glide path that was discussed before. We're talking about 5.1% of the GDP. That is a fiscal deficit target for FY25. Now, while to the average viewer, it might seem that this is an FY24 number, this is going to have its impact in FY25 largely. So that is one way it could go. Another is this gives a little more elbow room for expenditures that the government might take. We're expecting the full budget to come in July. While it might be late in the game for a big bang expenditure, what it definitely does is give some more headroom when it comes to what happens and room for contingencies as they arise. So those are the first thoughts. Back to you.
All right. Going across to Mr. Gandhi right now. Mr. Gandhi, now this obviously is something that, the government will be very happy about. How do you see this huge bonanza actually being spent now? Do you think that it's, given the fact that the government made so many promises on welfare schemes, is that something that a large part of this will go to? Is it infrastructure? Because now that is something already that we've seen a lot of expenditure on. So where do you think parts of this will go?
Yes, of course, we have to wait for the budget to answer all these questions, because what we have right now is only what on accounts. So when the full-fledged budget comes, then we'll get the clarity whether this kind of extra funds flow that will be flowing into the government, how they are going to utilize it. Whether it is partially something to go for fiscal consolidation, and something for extra expenditure, something for additional capital expenditure. So there is a permutation combinations are quite a large number of ways you can think about how the government will utilize this, or the new government will utilize this 2 lakh crores plus. So that we have to see. But definitely it is going to be a big shot in the arm for the government to manage its finances much better, because 2 lakh crores in a budget of typically it will be roughly about 10% of the total budget size, something roughly. So that is really bonanza, as you all mentioned. We agree to that. But the point is that the Reserve Bank has added this number after providing for all the required provisions to shore up its reserves, contingency reserves, and all of the reserves are automatically created. Then this is a pure surplus. To that extent, it is transferred to the government. That is all right.
Right. Madhavi, quick question to you now. Obviously, we'll have to wait for the budget to come out for us to get a better understanding of how this is going to work. But obviously, this is going to be a big boost really for the government's 100-day action plan. And they've already talked about it so much going in to the campaigns. So how do you think that is going to play out?
No, I think, see, we have to reckon the fact that the government anyway has moved the expenditure profile in a very meaningful way, where capex is more than 22% of the total expenditure versus, say, 5 years ago, it was less than 15%. And over the years, it has only been improving. Now, when the government is getting a bonanza, which is, say, a delta of roughly around 0.5% of GDP, because the budgeted number for dividend was close to 800 billion. So against that, if you've gotten almost a 0.4, 0.5 percentage point of GDP worth of, excess bonanza. Now you have a choice either to actually cut your borrowing or cut your fiscal deficit from a 5.1 to, maybe a 4.7 or 4.6%, or possibly spend that excess bonanza, and keep the fiscal deficit as is. At the same time, they can also do a mix of both, wherein they can use a part of this excess bonanza by cutting borrowing, and the rest could be actually utilized to increase expenditure, and thus the fiscal deficit gets lowered by a small margin. But definitely, to whatever extent, it obviously leads to a massive, impact in terms of, borrowing. If at all they tend to decide to actually cut the borrowing number, and of course it leads to a much lower, the cost curve across corporates. And if the government intends to actually spend this excess money, that also leads to a multiplier effect in terms of expenditure profile of the government, and obviously will be happening despite the fact that the government actually sticks to a 5.1% fiscal deficit. So I think we have to see how they actually choose between expenditure expansion or probably cutting their overall borrowing or fiscal deficit. But either ways, it leads to a massive increase in liquidity in the system, or massive impact on the interest curve in the economy, so which obviously will have a beneficial impact in terms of the multiplier.
Right, absolutely. As you're pointing out, obviously this will be a huge fill-up in terms of liquidity. Let me go across, I think, to Vishwanath, who has a question. Please go ahead.
Right, so my question is to Mr. Gandhi. Mr. Gandhi, 2019, when the Women's Committee report was accepted by the RBI Central Board, and you saw that contingency risk buffer being reduced to about 5.5%. Apologies, that was my cat in the frame, but 5.5% from 6.8 back then. So you saw the sharp cut in the contingency risk buffer, which was obviously questioned at that point in time because of the prudence aspect of it all. That helped the surplus transfer that year and raised it to about 1.76 lakh crore. What do you have to say compared to that to this now, the current highest sort of surplus transfer announcement is coming?
Of course, all these years, Reserve Bank has consistently showed up its reserves. All the unrealized gains, net unrealized gains, are not distributed. It is kept separately in specific reserves like currency and gold revaluation reserves, and even the investment reserves also. Any unrealized gains on the investment portfolio, that is also not distributed as surplus, and it is kept as a reserve, and it is pure whatever it has actually sold and bought and minus the expenditure, that is what is coming as a surplus of that year's surplus. And of that is how much to be transferred to shore up its reserves. That is what is based on that formula given by the Dr. Jalan committee. So based on that, it has been done. And whatever is the reserve, net surplus, it automatically belongs to the government. That's why it is being transferred. So this year happens to be a kind of bumper year, obviously because the foreign exchange reserves are quite high, and they all have been, in the last year, the yield across the world has been at a higher side. So obviously Reserve Bank would have gained a lot in actual inflow of interest income, and to the extent it has sold out the dollars for its stabilization purposes, that would have also fetched in capital gains relating to that. So that certainly is a big income. And another would be the interest income that Reserve Bank earns when it lend out of its reverse repo operations. So that is also coming to additional increase in income. So net of, because Reserve Bank's expenses are very marginal. So that way, typically the income, almost it is kind of surplus. That is why when a year like this, when the yields across the world, including India, is high, then the Reserve Bank gains much more income. And that's why that explains this high surplus. Whether it is going to continue in the next year, obviously it is unlikely, because when the yields, world yields come down, then obviously Reserve Bank's net surplus could be lesser in the coming years. For example, 3 years before, Reserve Bank transferred 1 lakh crores as its surplus, but the very next year it came down to 30,000 crores only, and last year it was 89,000 crores, and today it is 2 lakh. So it is a,
Right.
these are all factors which we cannot predict, that each year depends upon the dynamic situation of that.
Right. Mr. Gandhi, the question also is with regard to this the change in the CRD during the year. I wanted to understand what could have, as a central banker, former central banker yourself, what would have probably played on the mind of the central board to decide to increase? Because it's not like they were required; they were already at 6%, which is still within the range that was recommended. So, what would have probably pushed them to raise this?
Yeah, obviously, when we have the large surpluses, gross surplus is high, the natural tendency will be to retain a portion for reserves. When the room was available, that we have not reached the 6.55%, but the year's gross surplus is higher, then it is natural to think about shore up additional resource to go up to 6.5 rather than distributing the entire gross surplus as net surplus to the government.
Madhavi, just to you, I wanted to understand from you in terms of the growth in the RBI's balance sheet. Now, of course, that's something that you've been closely tracking. I wanted to get a sense from you what this year probably looked like in your assessment. I mean, obviously, we'll get a clearer picture in the annual report, but in your assessment, what did FY24 look like for the RBI?
So, I reckon with Dr. Gandhi that, the major, delta essentially has come from higher interest income, especially from foreign assets, because the estimated weighted average yield of shorter tenure foreign treasuries roughly would have increased by around 250 bips plus in FY24 versus FY23. And unlike last year, there was a material loss in duration and MTM on foreign assets versus FY24, where, the foreign bond market was largely flattish compared to what we saw in FY23. So the provisioning was much lower, would be much lower in FY24 from the profit pool. And of course, as he rightly said, the interest income from reverse repo would have also played a major part. So I think apart from the fact that they would have made some capital gain out of the fact that, they did FX sale at a much higher delta versus what their holding price was. The major delta in terms of the balance sheet or in terms of the profit book should have come from, much higher interest income from foreign plus domestic assets to a large extent. I think that should have been our biggest gain. But that said, I think we had also done our calculations and, with all the assumptions that we had made, it was still difficult for us to actually get a 2 lakh crore plus kind of a number on the RBI's profit book. So I need to really see where did we miss, the big picture here.
Okay. All right, Madhavi, hi, this is Pallavi here. I do want to ask you about what is the expectation going forward in terms of bond yields. We're already looking at, some softening in the yields in the medium-term outlook as well as in the near-term outlook. Added to that, today's news, what does it mean? What is the range that we're now looking at?
Yeah, very difficult, estimate to give because today the market has closed sub 7 on 10-year, the new paper. And, to be very honest, the demand supply dynamics in the bond market has been extremely comfortable over the last 1.5 years. The new players which have evolved, essentially the, insurance, NPS, and PF guys who have been increasing their, their books much massively compared to banks who are a major holder of GSECs, have essentially meant that the domestic demand itself has been sufficient to take care of the supply that has been emanating from the government's end. And with the, cherry in the top with regard to the foreign players, which are now going to be, playing a much incrementally important role in the bond market demand because of the JP Morgan index inclusion, would also mean that, there was any which way not much of a stress on the bond market, even with a decently high supply in FY25. But that said, I think, with expectations of probably lower borrowing this year, if at all the government does not intend to spend all of this money, would definitely imply that, you are looking at a much lower supply, given the estimated demand that you have, which gives a, intrinsic lower bias to the bond market in general. And this is, again, needs to be seen in conjunction with the fact that, you are seeing global bond yields also sort of softening and Brent also, behaving in a pretty rangy fashion. So I think it really augurs well for the bond market. I think, very difficult for me to give a range, but Market has already reacted to this news. I think next leg would be the election outcome and, of course, the budget that comes away. But directionally, things are looking very favorable for the bond market in terms of fundamentals.
All right. I request all of you to stay on. We're going to slip into a very short break. And when we come back, of course, we'll continue with this conversation further. So do stay with us. Welcome back. You're watching The Big Story on NDTV Profit. This is our special broadcast on the huge bonanza that the RBI has essentially given the government. We have with us all our guests still. We also, of course, have Mr. R. Gandhi and Madhavi Arora joining us. I'm going to go back to Vishwanath on this one. Vishwanath, we were earlier talking about how this contingency risk buffer has actually been increased. In 2019, something similar happened and there was a huge bonanza when the new government came in. But at that point, it had actually been decreased. So what do you make of it? Was it really necessary? How is it going forward, especially given the fact that Mr. Mahindra has also, talked about it in his first reaction that's come out?
Right. So, Nupur, as I was talking to Mr. Gandhi right before the break, he's pointed out that typically when you have these heavy bonanza sort of years where your income suddenly shoots up quite a bit, and typically the economy is looking resilient, there's really no fear of things going sort of sideways in the near future. So you would see the RBI retain some of that income and retain some of the profit that removing the expenditure within its balance sheet as a risk buffer, contingency risk buffer. Now, contingency risk buffer is also important in the event that something volatile happens in the economy later on. But of course, here it was at 6% till last year. Now it's been raised to 6.5%. They didn't really have to do it, but they did it because clearly they've had a really good year. But Mr. Gandhi, I wanted to ask you one question with regard to where we are in terms of the amount that has been set aside. Madhavi is pointing out that people who are looking at the RBI's balance sheet and projecting growth, they seem to have missed something, and that's probably showing up in this large surplus transfer. But I wanted to ask you, in February, when the government was making its vote on account, at that point in time, they would have taken some guidance from the RBI to arrive at that 1 lakh crore number on the revised estimates, right? What has changed in just 2 months? Because by 31st of March, that 1 lakh crore has suddenly doubled.
Okay. Of course, the initial estimates based on 6 months or 8 months of the year's accounting, based on that, some projections would have been done. That is one. Second, most of the time, what probably market analysts just now, as you mentioned, what they would miss because the information might not be available readily. That relates to Reserve Bank's profits out of sale of foreign exchange. Because the sale of foreign exchange, when it is accounted, it is based on the weighted average rate of the day when the foreign securities are sold or foreign exchange is sold. So weighted average, it will be over the years. Because the reserves have been accumulated over the years. So even though today the dollar rate would be at 83 or 84 or whatever it is the number, but the weighted average could be much lower. So that part many times your market could miss out. That is one. And the proportion in which the foreign exchange reserves are invested in foreign securities, foreign deposits, foreign currency deposits, that also would explain the differential in the yield that would come. And plus the way the Reserve Bank would churn the portfolio, that can also bring in better capital gains kind of surplus. So that way, varieties of ways in which the surplus would have come. And whether your specific question is that between the estimate given sometime in, let us say, late November or early December for the purposes of vote on accounts, and now finally in March, these 4 months, what could have explained that kind of big differential, 1 lakh crore kind of differential, that we have to wait for the actual accounts only.
Right.
Whether the it was kind of bunched in the later part of the quarter, the year. So that we need to see.
Okay, thank you so much, Mr. Gandhi. Madhavi, a quick question for you as well before we can wrap up. Considering that the next big event to watch out for is the next budget, what does this figure mean in terms of the fiscal math? So can we, looking at the interim budget, the government has been fairly conservative with its estimates in terms of nominal GDP as well as revenue. And given today's figures, what are your quick expectations from the upcoming budget? How much of a rejig will we see in terms of some of the figures that the government had estimated in the interim budget?
I think the first step would be to see the election outcome, because that will determine a lot with regard to, how fiscal rejig would happen. Assuming that, we get the expected outcome with a comfortable BJP majority, I think the policy prerogative will not change in the upcoming budget. As I said, that the fiscal delta bonanza that you're getting out of additional dividend versus expected is roughly around 0.5% of GDP, right? So that excess bonanza can either be used to reduce the fiscal deficit or reduce the borrowing consequently, or could be used to actually, increase the spend, and the spend could be distributed equally between REVEX and CAPEX, or whichever way they want to. But the expenditure profile can actually, blow up by around 0.5% of GDP, which again is neutral for fiscal because the fiscal remains at 5.1%. Or if they choose to actually reduce the fiscal deficit by the same amount, that obviously means that the borrowing could also come down by more than 1 trillion. And if they choose somewhere in the middle path, wherein part of the borrowing could be reduced, or part of the deficit could be reduced by using the surplus, and a part could actually be spent, which leads to probably a 500 to 600 billion of lower borrowing compared to initially announced. So they could do a mix and match of these things, and of course, a lot would depend on the election outcome and the margin of win.
Oh, yes, absolutely. So we'll have to wait and watch out for how this really pans out. Thank you very much, Madhavi. Thank you, Mr. Gandhi. Thank you, Vishwanath. Janani, as well as Pallavi, of course, who's with me in the studio. Thank you all for joining us. Well, that's a wrap on the show. This evening, you were watching NDTV Profit and our special broadcast on the huge bonanza that has been given by the RBI to the government. Stay tuned for more.